You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again for Education Wednesday time. Once again, for the premier options education program. Yes, it is time once again for Options Bootcamp. My name, of course, Mark Longo from theoptionsinsider.com. Reminding you, if you like what you hear, you're on the on-demand side, one of our many legions of on-demand listeners. All we ask at the end of the day is that if you like what you hear, you do keep rating and reviewing. It does clearly help new people discover the show, just like Mandy did this week. She gave us 5 stars saying this is the, quote, the, all in caps, the show for options traders. Well, thank you for that, Mandy. And everyone else takes the time out there from your busy day to not just listen, but rate and review. We love you all. Of course, you want more in your lives, and who can blame you? You want more content. You should be, listening to the full network. That will get you a lot of content. And then if you want even more on top of that, the cherry on top, the icing on the cake, then, of course, head on over to theoptionsinsider.com/pro, or for you cool kids, /secret club. That'll get you access to exclusive pro Q&A sessions. If you folks have questions, and clearly we're going to answer a bunch of them today, so clearly you folks do, then the pro Q&A sessions are the place for you. We pick the brains of all the best minds in the world of options and derivatives. Allow you folks to run wild with all your questions. So those are great. Just did another great one just yesterday. So all sorts of fun popping off out there. Of course, Options Oddities, the end of every week. Pro giveaways like our Pro Trading Crate. Just congratulations to Pete05, one of our new listeners who won the Pro Trading Crate last week. So congratulations to him out there. And of course, live access to this, everything else we do here on the network. So if you want to heckle Dan or any of our other cohorts here on the network, theoptionsinsider.com/pro is the place to go to learn more. And speaking of the black-hatted one, we are joined once again on the old OBC program by Mr. Dan Passarelli, the founder of Market Taker Mentoring, beaming in from the financial mecca of Frankfort, Illinois. Mr. P, welcome back to the show. How go things in the financial mecca of the world, sir?
Hello there, Mark. Things are going swimmingly here, and we've got some great things to talk about here today, I think. So I can't wait.
I think we do as well, so let's get to it. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call, the portion of the show where you folks take the reins, your questions, your comments, your insights, your pearls of wisdom, your harsh, bitter accusations, all sorts of fun coming at us here on the old mail call. You folks know how to hit us up at Options on most of your favorite social media platforms. Questions at theoptionsinsider.com also works. If you're one of our pro members, of course, you get bumped at the top of the list on the live chat or via the members hotline. A lot of ways. You can even use our app to get at us. No shortage of ways for you folks to find us smoke signals here in downtown Chicago. We'll probably find you. All sorts of fun out there. And Dan, I know you've been waiting for your moment. The folks out there are waiting with bated breath, sir, for their much anticipated MTM question of the week.
All right, Mark. Well, I've got myself one of those. So I was speaking with a prospective student today. Yesterday. And he was interested in one-on-one coaching, which, is for people who are pretty serious about their trading and they want to finally stop messing around and finally start getting those results, right? And so I explained to him what the program was all about. And he said, man, this sounds really great, but I got to be honest with you. I don't know what's going to happen when I talk to my wife, and this comes up, one out of every 25 people, men or women, who are just concerned about what their spouse or partner, significant other is going to say about it and maybe afraid that they're going to say no. And so it kind of comes down to there's like one of two people in the world, right? When it comes to spouses and how they feel about your trading. There's the ones or paying for education, I guess I should say. They're the ones who say, that is too expensive. You better not spend any money on learning how to trade better. And then there are the ones who say, you better not make another trade until you go and take a class and learn how to trade better. And, for me, I think I know which one that I do know which one I am as a spouse and as a person in general. And I'm fortunate that my wife ends up feeling pretty much the same way. And so I haven't heard back from this person yet. But we will see the way that his spouse thinks about the value of education and, what that provides and why one should consider getting educated on anything, not just trading, but anything before jumping in head first.
The significant others. Always gumming up the works there. Mr. Passarelli out there. I'm sure lots of card dealers are out there, and they know the guy comes in, he's all excited about some hot new card, but you got to sell the wife, right? And it's got to be practical. So always the challenge out there at the end of the day. You know what else is the challenge, Mr. Pete, really quickly? Are these markets kind of crazy, kind of topsy-turvy out there right now? In fact, as we're recording this, listeners, on Wednesday, we're selling off again. S&P off about 1%, so back well below that 41.5 level. We've kind of been bouncing around all over the place yesterday. Of course, Dan, since our last show, we've had all sorts of madness out there in the markets, courtesy of our friend Mr. Powell and the Fed out there coming out and not really saying the most dovish of statements, and yet the market really got the bit in its teeth and ran with it. They rallied the hell out of this thing. They came in the next day and some pretty terrible overnight earnings from the big tech names. They still tried to rally this thing. And then, of course, we saw yesterday Powell speaking again, the market starting up, shooting up 1%, then selling off 1%, and then bouncing around pretty much 0.5% up and down throughout the rest of the day. So a lot of crazy whipsawing going on out there. Mr. P, I got to ask, what are your thoughts on these crazy markets, what we heard from the Fed and the market's reaction so far, sir, which has been, I think, to put it charitably, all over the place, sir?
Yeah, it's been all over the place. I mean, we put out a daily video to the folks that are on our email list. And, I've been talking about it for a while. Like, if you're paying attention to what Powell and all his little friends have been saying, and you're paying attention to what's going on with earnings results, there's not many surprises out there. I think if you're not paying attention, you're surprised more. But the only surprise that is out there is why the market is up as high as it is. And I don't know, like, nobody likes, listening to somebody who's, got negative news or anything, but and I'm like nowhere near a perma bear or anything like that. I'm a pretty positive guy overall. But I mean, basically, the Fed is telling us that we should sell stocks, especially if there's any news about more employment than we wanted or higher inflation than we want. Like yesterday, the day before, Powell literally said that if he sees either of those two things happening, they're going to have to get more aggressive on rates and basically telling you should be selling stocks. So I don't know. I mean, it's hard to be surprised if you're paying close attention, but I don't know. You get a couple of mini surprises now and then where Powell said, like, what was that yesterday, I think, right? Powell says something bad and, the market rallies. It's like, what are you thinking?
Whistling past that graveyard. Of course, we had that jobs number that came as a huge surprise to everybody last Friday as well, Powell seemingly included. Yeah, that really spooked a lot of people as well. So that led to, first people tried to rally off that. It's been just crazy town out there, which leads to our question. We asked folks last week, Dan, the markets are rallying hard off the Fed announcement. Does this rally have legs or is this just a dead cat bounce? And Dan, our audience, they're going the perma bear side, almost 2/3, 65% saying this is a dead cat bounce. 35% going in the rally ho, keep buying mode. Does that surprise you, Mr. Dan? Or is that pretty much what you expect?
Yeah, I mean, that's pretty much what I expected. I mean, there's like the when in doubt, you just go with like the long-term statistic, whereas, the market goes up 8% or whatever it is a year. And so, for people who are just looking big picture overall and not digging too deep, sure, buy. 5 years from now, you'll be fine. In the short term, within the next 6 months, I don't think you'll be fine. And I think that's why we got 65% people say, disagree with that statement.
Our actual question of the week this week, Dan, we're going to drag you back to the crypto side. We asked our folks inspired by our crypto rundown program, which if you're into crypto listeners, you should be listening to that. It's on every Monday. It's on the network feed for you whenever you like on the on-demand side. Asking them this week, Dan, if you had to buy a 10% out of the money call expiring at the end of the year on one of the following crypto assets, which one would you pick? And we opened it up to write-ins if you folks want to write in. But we gave you the big three, Bitcoin, ETH, and Solana, at least in terms of crypto derivatives markets. Or the fourth choice, Dan, I'm done with crypto. Which of those are you choosing, Dan? Which one do you think our audience is choosing?
Well, I would go with choice 4B. I'd rather stick my right hand in a meat grinder. But I mean, I have said, and I'm still going to say that in the long run, so not within the next year, for sure, within the next year, I'm done with crypto. But, in the long run, like Ether or Solana are probably good choices because they're going to be powering Web3. Unless something else comes to replace them that's yet more efficient for that. But, Bitcoin, as Bitcoin stands right now, is the worst investment. But it's still buoyant because it was first to market and it's the name that, people know. But yeah, I mean, I'm done for the next year for sure.
Dan washing his hands. You think our audience is done too?
Oh boy, I don't know. That's yeah, I do think they are. Yes.
So spreading that cynicism off to our audience, you're close, not quite there. 36% choosing Bitcoin, Mr. Dan. So they're still in on the first mover, which is Bitcoin. 28% though. So number two are with you, Dan, saying I'm done with crypto, at least for right now. 20% number three for ETH and 16% for Solana. That's more than I thought for Solana. Kind of seemed like the writing was on the wall for Solana post FTX. It got down to sub $10, but it has had a nice run over the last month and change. It has more than doubled. So maybe some folks are back on the Solana train. Either way, I'm curious what you folks have to say, listeners. At Options on the old Twitter is the place to go to make your voice heard. If it's not pinned up there, it's floating around. We try to retweet it throughout the week. So you folks can play along in our question of the week. Speaking of you folks, let's get out to you folks right now. First, we got it's not really a question. It's more of a comment from Tim Donahue. Obviously, he's been listening for a while. He says, Tell Mark I sold some 2 puts in March on Oatly. So now I'm on the Oatly train with him. Let's go. Well, I'm happy and or sad to hear that there, Tim. Let's see. I'm guessing, given what's going on in the market, I haven't pulled it up today. I'm guessing Oatly not looking good today. Oatly off, down to about 2.25 again. Was trading 280 not too long ago, so it's had quite a move over the last week and change out there. But yeah, Dan, this has been a ongoing saga we've had on our pro side on our Options Oddity show. We've been trading around Oatly and selling puts, and it's just gone straight down. It's been pretty funny and or silly to watch out there, but it sounds like Tim is on that train. Speaking of which, listeners, we asked you guys a quick flash poll during our pro show last week, the Options Oddity show. We said, inspired by our lively debate on options oddities with our buddy, the Rock Lobster there, he said, if you had $10,000 to, quote, invest, and I use invest loosely when a name like Oatly, it's more like betted on the horses there. But invest in one of these stocks right now. Which one would you choose? We said Apple, Oatly, or are you just going to keep your 10 grand? And 53.3% of you chose Apple. 40% said, I'm going to hold on to my 10 grand, thanks. Only 6.7% of you chose Oatly. Dan, that's about what I thought. I actually thought Apple would do a little bit better. Does that surprise you, sir? No love for Swedish oat milk in our audience.
Yeah, I mean, I can't really say I'm super surprised, for sure. So yeah, no, I think these results probably look pretty good. I mean, of the tech names, Apple's the one that's kind of hung in there fairly well.
They rallied it off terrible earnings, the worst earnings in like 6 years. No, let's rally it.
yeah. Crazy, man. Crazy. So yeah.
Last week was a good week for bait and switch on the earnings front. Apple managed to do it. Facebook's like, pay no attention to these losses over here. How about $40 billion worth of stock we're going to buy back? All sorts of impressive baiting and switching going on the earnings front this year, listeners. Always a fun dance to watch, and they're certainly getting creative with how they do it, or in the case of Facebook, just very expensive. They could have bought twice as much stock a month ago if they had done it earlier. Just all sorts of insanity. Speaking of insanity, let's keep the ball rolling. We talked a lot about vol products last week, so I had a feeling a few of you would have questions along those lines. Let's start off with Peyton here. Peyton says, why did they delist TVIX? It seems like it was still popular. Yeah, we talked about TVIX. This was the Credit Suisse product that they kind of jointly marketed with Velocity Shares. This was the 2X VIX short-term ETN, so it was a note. They pretty much delisted it back in 2020. I think they announced it in June, and they delisted it in July of that year. So it's been dead for a few years, but you're right. It was a popular product. We never got into it too much here on the network for a couple of reasons. A, it wasn't optionable. So for a lot of our listeners, it wasn't really a preferred product. B, there were a lot of issues with it. They had, similar to what we saw with Barclays and VXX last year, with the issuer kind of having some problems with the fund flows, and that ended up causing all sorts of problems, wreaking all sorts of havoc with the product itself. That happened to TVIX way back in 2012, I believe it was. So we had the writing on the wall for that product a while ago that there could be some weird issues with it. And so that kind of made me leery to go into it as well. Once a product has gone completely haywire, it's on you if you decide to get into it again and it does it again. And so I kind of washed my hands of it, kind of like I had with VXX. I kind of washed my hands of it, of TVIX post 2012 ever since. So it didn't really surprise me that they delisted it. But you're right, it was popular. It was still doing volume. In fact, I think the month that they announced they were delisting it, it was one of the top names and ETFs that people were adding to their portfolios over there at Robinhood. So people were really piling into it then. So it was still popular. You're right. But you forget, there are issues behind the scenes. This is one of these short-term products that's effectively just rolling and getting annihilated all the time by that roll yield you were talking about before. So if you're Credit Suisse, you're on the hook for that note. You have to manage this portfolio, this ever-eroding VIX portfolio out there. So you're making money on it. I think the last I saw were estimates somewhere around $25 million a year in fees. So I'm sure they like that part of it. But on the flip side of it, the management, the cost, the risk associated with having this VIX position on your books, these are not inconsequential. And so this seems like for them, the calculus was, it just wasn't worth it for them at the end of the day. They didn't just kill TVIX, by the way. They killed a bunch of ETFs and ETNs over there, deciding they wanted to delist it in an effort to, quote, better align its product suite with its broader strategic growth plans. So esoteric ETNs and ETFs that they had on their portfolio. They kind of delisted a bunch of them, I think, to focus more on some of their core offerings that maybe made them some more money and also didn't have all the inherent risks and managerial problems and complications associated with them. Dan, is that your takeaway as well? Were you ever a TVIX guy, sir?
Yeah, I mean, I think I traded it before a while back. I mean, that statement is funny. It sounds kind of like that, when the politician says, I'm going to take some time
spend some time with my family. Yeah, they kind of damned it with faint praise there. But you're right. At the end of the day, follow the money. And clearly the money wasn't enough for them to put up with the other hassles that are clearly inherent in managing a product like this. Speaking of products and hassles and issues, Dan, let's go out to JDM. JDM wants to know, so you guys have talked a lot about the same day trading in SPX. Obviously, he's referring to all that zero DTE stuff, listeners. He says, but how can this realistically impact VIX when the calculation is based around 30-day options? You know, I've heard this a lot, Dan. I've heard this bandied about in a lot of different circles. And some folks, even learned folks out there, are trying to maintain that this tsunami of paper literally cannot impact VIX because the calculation is based around the 30-day option. So I put it to you, Dan. I've weighed in this a few times. I'm curious what your thoughts are. Do you agree with JDM that this same-day tsunami cannot impact VIX because it's only based around 30-day options, sir?
Well, I mean, yeah, the math indicates such because those options are not part of the calculation of VIX, right? So, I mean, I guess the question becomes, it would be unlikely to have any material effect on VIX under most circumstances. How about that for hedging my bets?
You sound like the politician going to go talk to hang out with your family now, sir.
Yeah, exactly. I mean, the only way, like mathematically from a direct relationship, well, obviously, no, it does not factor its way directly mathematically into it. I guess there's maybe two kind of ways where maybe it could. One is if there's just massive one-sided positions in there, which would be like a firm stepping in and trading, one single firm's trading a gigantic spread, which, I don't think you really see all that much of that. Then the arbitrageurs who kind of hold the term structure into some sort of logical model, they'll go out and buy or sell further out options to hedge off those shorter term options. Although they won't want to be doing a lot of that because it's going to expire in a day, and then they're going to be saddled with only the hedge. Or if the trade goes massively against the person who put on the 1-day option, and it's like a big negative gamma trade, there's the potential for what I guess you'd call a gamma squeeze. But a lot of these trades are traded. A lot of them, maybe I guess all of them, are traded in like SPX and spiders and NDX, on the days that it's available. So there's just so much deep liquidity there. I don't know, man. Yeah, it does. It's typically not going to have much, if at all, of an effect on VIX.
I'm on the record saying that I don't think we fully understand the impact of this because it's so new, right? The analogy I use a lot is looking back when the weeklies really came online aggressively a decade or so ago. And look what the impact they had on the monthlies as a result. We saw liquidity get cannibalized, migrate from the monthlies into the weeklies. So we started to see some changes with how the monthlies performed. Their decay profile got a little bit different. They weren't quite as liquid anymore. And so things changed a little bit with those. And I think we're going to see something, if we haven't already, similar out there in SPX. By the way, I just pulled up SPX. Let's just do a little check right now while we're talking, listeners. And of the top 20 most active contracts in SPX, and by the way, SPX has already done nearly 2 million contracts, but 1.85 million. So not a slow day out there. And I'm looking here at the top 20. Dan, take a guess. How many of the top 20 do not expire today? So how many of the top 20 most active contracts in SPX do not expire today, sir?
I don't know. Half, maybe?
You might think that, but the answer is none.
Oh my
Every
gosh.
single contract in the top 20 today is all expiring today. And I guarantee you, I haven't hit it yet. If I hit that button to expand it to the top 40, it's probably going to be about 35 of the top 40. That's what it usually is. Let's see here. If I can I hit the wrong button here. Let's go back to that. There we go. SPX. And bam. Let's see. Now top 40. Let's see. I see 3, Dan, in the total top 40 of SPX that are not expiring today. So your most active non-expiring today contract are 7,500 of the 4,200 calls expiring on the 10th. So, I mean, look at this. This is SPX. It's putting up nearly 2 million contracts, and you have to dig all the way to the bottom of the top 40 to find the first contract that is not expiring today. This is a sea change in the way this product is trading. So I don't think anyone can say, look at this and say this is not going to have some unintended ramification. I think that's what we're seeing right now. I think a lot of people out there who thought last year VIX was maybe somewhat muted. I mean, there's a lot of arguments that go into that. Of course, we started the year at a pretty decently high baseline and actually went up. We started the year last year at about a 16, and we rallied up and hung out most of the year in the 20s. So VIX was already kind of at a pretty high baseline. So it was kind of hard for it to pop from there, as opposed to when you start at, let's say, a 10 or a 12, and then you shoot all the way up to a 20. You know, that's something you could maybe more realistically expect. So people were hoping for that bang for their buck. They didn't get it. But I have to also assume that some of this onset of these zero DTEs in the latter half of last year, the second half of last year, also, I think, stole some of that thunder. Do you really need to load up on a lot of VIX upside, let's say, or maybe even VIX futures? VIX futures were in the toilet this last month. Nobody's touching those things. So there's a lot of products that are maybe starting to fall by the wayside because everyone and their mother is trading these things. So I don't think, Dan, I'd love to see some papers done on this because it's still very new, exactly what the impact of this is. I also think, mathematically, looking at it, in fact, I pulled up the methodology from the SIBO website. I was surprised actually how dated, from the SIBO's own volatility website, how dated their explanation of the calculation of VIX is. They haven't updated it in about 5 years. That's kind of interesting. According to their own methodology, you can go pull this up yourselves, listeners. SPX options with more than 23 days and less than 37 days to the Friday SPX expiration are used to calculate VIX. These SPX options are then weighted to yield a constant maturity 30-day measure of the expected volatility of the S&P 500 option. So you do have some nearer dated options making their way into that calculation. And also, the point has been made many times that market makers don't exist in a vacuum. If they see nigh on infinite demand for their near dated contracts, like if people are just buying the hell out of these zero DTEs, that is going to start to make its way throughout the rest of their models, and they're going to start raising the vol levels. They're not just going to price vol for zero DTEs at some infinite vol level and keep everything else the same. They're going to start raising those as well. So if you start seeing crazy paper in the zero DTEs, that could make its way out further along the time frame, certainly out to the rest of the weeklies and maybe even out to close to that monthly time frame. So there are ways that the tsunami, and it is literally a tsunami, and this is an overwhelming amount of paper. There are ways that this tsunami of paper can impact the calculation itself, as we've seen it. You only have to go out to 23 days to make it into the literal calculation. So I think the moral of the story, who asked this, JDM, is that we don't quite know yet. That's the big question. VIX was kind of doing some weird stuff last year, and people are still puzzled as to why. And this could be one of the explanations. And there are many things. Like I said, we started high. There was also a ton of vol upside that people traded earlier in the year and were putting on throughout the year. Crazy upside. OI numbers we have never really seen before in VIX. People are loaded up on the pars and the 115s. Maybe that had something to do with it. Maybe the fact that people already had their hedges onto the upside, the need for gobbling up vol aggressively all the way up wasn't really there. There are a lot of potential suspects as to why last year, from a vol perspective, was a little bit wonky. But certainly, I would not rule out these zero-day ones at all. So I think right now, JDM, we need more information, quite frankly. But I am suspicious. Dan, color me suspicious, Dan. I don't think you can just change the way the largest institutional product on the planet, one of them, trades like almost overnight. And of course, the basis for VIX. And it's not going to have any ramifications on the VIX. I think it probably will. We just don't really know what that is yet. So Dan and I are going to be on opposite sides of this coin. We're going to be arguing bitterly for the next 6 months as the data comes in here. So Dan, put on your debating hat and your debating pants. I know you have special pants. And get ready for that. Because this is a fascinating question. I think it's going to be, as far as I'm concerned, all the people doing all these presentations at RMCs and all these SIBO risk conferences and everything else, vol conferences, they should all be talking about this, because this is the big question that I don't think anyone has really answered satisfactorily yet. All right, let's go out to Andrew. Andrew Metz. He says, again, more vol questions. When you said, I should say, SVXY was a neutered volatility product, what exactly did you mean? I trade it regularly and it works fine for my purposes. Well, I'm glad to hear that, Andrew. And if we're ever here on the show and we're dismissive of a product, but it works for you, good. That's great. We want you guys to be successful at the end of the day. Let us not rain on your parades out there. What I said for me was that SVXY back in the Balmageddon of 2018, they came along and mid-cycle just overnight neutered these products. They cut the leverage in SVXY. It was supposed to be a 1x inverse product. They cut it to half X, while these contracts were still open and alive. And so that really just annihilated all of the premium. In the case of SVXY, a lot of people had upside in that, myself included, because that's how you played that product. And all overnight, those calls lost pretty much all of their value. Who wanted to have these calls on a half X neutered product now? And they did the same thing to UVXY. It's 1.5 as opposed to 2X now. So UVXY can still serve a purpose. SVXY for me kind of lost all of its meaning, all of its resonance for me when they came and did that, for a couple of reasons. Left a very bad taste in my mouth to see a contract that you put on in good faith have the terms of that contract be adjusted outside of some event like a dividend or something else, which you kind of expect. This was just a vol event for a vol product, and they just completely changed the payout structure of this product. I didn't like the way that was done. That left a bad taste in my mouth. And just also now it's a neutered product, so it didn't excite me. But if it works for you, Andrew, go to town. Dan, were you part of that whole SVXY, UVXY brouhaha back in 2018? And what are your thoughts, sir?
Well, I mean, I have never traded it. But to Andrew, to your point for Andrew, I'm pretty much in agreement with you on this one, Mark. If it works, keep doing what you're doing, man. My thoughts, because I think we talked about this on the last show, and I think I can paraphrase my thoughts fairly well. But my thoughts on SVXY last week and now is that I just don't understand why it exists, why it's necessary. But I mean, hey man, if you can make money, you figure out a way to make money betting on some, crazy tiddlywinks game or something, and it works for you, keep doing it. It doesn't matter if it makes sense, if there's a reason for it. If you figured out how to exploit it, by all means, brother, keep at it.
I was at my son's basketball game yesterday, and there was a parent telling me about a friend of his who is making good money bookmaking in Bulgarian table tennis.
Oh my God.
And I said the same thing. I was like, well, I guess if it's working for him, more power to him, right? I don't think he has many competitors bookmaking in that, but apparently it's a hot market, Dan. So maybe after this, you and I should consider a new show. What do you think? The Bulgarian table tennis show.
Hey man, if there's a market out there, why not, right?
If it's got depth and liquidity, we will trade it here at the end of the day. Let's keep going here to Melanie. More questions from our show last week. Melanie says, let me see if I have this correct. Products that roll down the VIX curve like VXX typically lose money in contango environments, but they can make money in backwardation environments. The short answer to that is pretty much yes, Melanie. She says, so does that mean I should buy VXX during those market periods? Well, I said before, I've kind of washed my hands of trading VXX. It's not my favorite vehicle, but I did say it has some value around these moments. That's when I said you should maybe keep it in your watch list. You start seeing it tick up aggressively. I mean, maybe vol's ticking up, or maybe also we're seeing some of, as she points out here, some of that backwardation creep in to the VIX curve out there. And those are interesting times. So those are times when VXX should hold its value better. And maybe as they roll, it could actually, in your hypothesis here, Melanie, actually gain some value. Remember, you're actually selling out a more expensive front month contract and then buying a cheaper second month contract. So you're actually making money on that trade. So if that is the period when you are enticed to trade VXX, it can't work. Just remember, when VIX is backward, that's when you really got to sit up and pay attention. That's when things are getting kind of crazy, kind of wonky in the market. And it's not exactly for the faint of heart. So if you're not comfortable with all these terms you're throwing around, then I think it's probably better to sit on your hands, let alone diving into a product like VXX. But Dan, you're an old school VXX fan. I think less so now, as we discussed last week. What do you have to say here for Melanie? Should she be buying VXX when VIX is backward?
Yeah, if you are going to be trading this, yeah, you got it exactly right, Melanie. The way you phrased it is exactly correct. And this is like pretty indicative of a lot of things with option trading. And I love that you came to that conclusion, from either listening to us or things you read or whatever, because so many people just get this rule of thumb in their head and don't look into the why behind it and end up getting caught up and losing money. Like there's a bunch of examples of that in options. Like, people say, oh, the only way you can make money in options is by selling it. Well, that's because volatility in options is typically slightly elevated, but it's not always elevated. Sometimes it's underpriced and you shouldn't be selling it. You should be buying it. You're better off selling near the money options because they decay faster. Well, that's true, but depends how far away they are. And what you really should be doing is looking at the theta, because you might find that an option you think decays faster actually doesn't, whether that's because of the term structure or proximity to the money. So, yeah, this is great, Melanie. Like, I bet that you are either already a very good trader or you're definitely on your way to becoming one because you're picking up on these little nuances.
And you can tell she's a very savvy trader because she listens to us, Dan. Clearly a woman of discerning taste out there. I would just add, Melanie, if you are going to buy VXX, remember, we said it on the show last week, even in periods of backwardation, this is a short-term trade. You don't want to buy and hold VXX and set it and forget it and come back a year from now and check on it because guess what? It's not going to be looking too good. So if you're going to buy it in these backward periods, you might want to might get a little pop out of it, take advantage of it, but then move on to something else because buying and holding VXX is a loser's game at the end of the day for all the reasons we broke down on the show last week. Since we're talking backwardation, let's get to this one too. Let's go to T Makachev. T Makachev says, can you please discuss the role of buying VIX puts during periods of backwardation? Does this strategy make sense? All right, let me see if I got you straight here, T Makachev. You're waiting for what we were just talking about, those periods of backwardation. So when the front VIX futures are priced higher than the longer term VIX futures. And that's the moments when you want to buy VIX puts. I would say normally that strategy does not make a lot of sense because those are the moments when VIX puts are probably going to perform their worst, right? When the vol is popping, when things are backward, VIX puts not going to be doing well. Vol is usually going up in those environments. So the one caveat I would add, the one scenario where I would say this could make sense, if you feel you're an excellent timer of the market, you think you have a handle on this backwardation thing, and you know the precise moment when this backwardation is going to end and that term structure is going to return to normal. If you can do that, A, I tip my cap to you. That's impressive. And B, in those moments, yes, if you bought VIX puts and then the term structure, that front portion collapsed, you could end up doing pretty well in that environment. But that, to me, is the only real scenario where that makes sense. Otherwise, you've kind of outlined a time period where you really probably don't want to be buying VIX puts for all the reasons we've said. Things are backward. Things are crazy. Vol is probably going to stay firm, if not trending north. Not exactly an environment where you want to own a lot of vol puts in, but intriguing stuff. Mr. Dan, what do you have to say here for T Makachev and his interesting VIX put strategy?
Yeah, I mean, if you know when those puts are going to kick in, please give me a call.
Yeah, you need a newsletter or something. Yeah.
Yeah. But yeah, I mean, I don't know, like buying puts is when you expect the thing to go down, and the underlying for VIX is the expected value of the VIX 30 days from expiration. And so if we're in backwardation, that means that the further out in time we go, the lower the VIX is expected to be at its respective expiration. And so, I don't know. I mean, in all likelihood, it's probably already priced in. I mean, unless we're going from a period of very high and very contango, just getting to backwardation. I don't know. There's a lot of factors there, but I mean, if you again, same thing. If you figure out a way to make that work and really dial it in and looking at this very, very, very fine-tuned thing, by all means do it. But, I would say this is not one where you say, oh, it's in backwardation, buy puts. Like, I don't think that's it. I think it's a little more nuanced.
Yeah, that's not the buy signal for VIX puts. Backwardation, buy them all. But Dan, this does prove, though, we have the savviest audience out there. I love our folks out there. They ask all kinds of great questions. You folks are the best. Keep them coming. We'll get out of here on this one, Dan. This is a question for you. This comes from Kenny. Kenny just wants to know, does Dan still do the rating? I like that. Do the rating. Does Dan still do the rating, or did that end with the meme stocks in 2021? So, Dan, inquiring minds want to know, do you still do the rating?
Yeah, I still do the rating when the rating is good. And so here's the thing, like, I did develop that short squeeze program during the meme stock. That's what got me interested during the meme stock thing. That's what got me interested. But, it falls in and out of favor. And, I think we're going to need more of a bull market for that to really get into favor. But that being said, there's always opportunities out there for a short squeeze to happen. And it doesn't have to be some meme stock. It doesn't have to be one of these that, everybody talks about on Reddit or something. Like, short squeezes have been going on for 100 years. So it's a system that will always be relevant. I trade it a lot less right now, but it'll always be relevant.
Dan will always be doing the rating, sir. All right, Mr. Dan, that music means we've come to the end of our rating, at least for this episode. Great questions out there, everybody. You folks are legit, as the kids say, when you guys start bringing the heat with your questions. Mr. Dan, if they have more questions, they are not sated after today's mail call episode. They want to hit you up directly. Where should they go? What should they do?
Yep, we love to help our listeners. We are at markettaker.com. And, if you join free, you have the chat room access to be able to talk with us and to get our daily videos. So that's a great way to communicate with us and get communications from us that I think can help move you even further forward.
There you go. Market Taker, 2 T's. Don't forget the second T for Theta over there, listeners. That is going to do it for us on the live today. You folks already got your on-demand dose of Options Playbook Radio. Coming at you a little bit earlier these days. We have extended Education Wednesday to include a little bit of Tuesday as well. So OPR coming at you usually on Tuesdays now. Maybe we'll get it into Wednesday as well. Next week, we will be getting some live dose of Brian out there, so that should be good. In fact, stay tuned, buckle in, listeners, because all the folks on the live side, on the pro side, you'll get another double dose of Boot Camp. Dan and I coming at you with 2 episodes live next week. So if you want access to that, to the live huddle I'm going to do with Brian on OPR next week, as well as all the other shows we do live throughout the week, as well as, of course, Options Oddities and another great pro Q&A session. You know where to go, theoptionsinsider.com/pro. We'd love to see you in there asking all these great questions live. We'd love to hear from all of you out there. And then we're, of course, back again with more shows next week. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.